The latest economic data is in, and a recession is nowhere in sight for the U.S. economy. The labor market is running strong, consumer spending is robust, and other sectors are also pointing towards continued strength in the U.S. economy. Now, that's not to say there aren't warning signs out there that could spell trouble later in the year. In today's video, we're going to look at the latest data and what it all means for the housing market. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis for the U.S. overall as well as regional markets. Today's video is covering the U.S. economy, which can have a big impact on the housing market. If you're new to the channel, my name is Eric and I am a professional economist in addition to being a licensed real estate agent. So you get a unique perspective here that you'll be hard-pressed to find on other channels. Let's not waste any time, get right into the latest economic data to see where the U.S. economy is headed. Let's start with the labor market. The latest data from the Bureau of Labor Statistics showed the labor market added 303,000 jobs in March, the highest rate of job creation since May 2023. This is definitely a strong number and suggests U.S. businesses are faring well as they continue to add jobs at a robust pace. It's true that the labor market is a lagging indicator and not the best metric for assessing real-time performance in the economy, but the trend is what is important. Rather than a slowdown in hiring that would suggest trouble, we're actually seeing an acceleration in job creation. Another important measure to look at is the amount of slack in the labor market. According to the latest report on job openings, there were 8.8 million job openings in February, which was down from the peak of 12.1 million back in March 2022, but still well above where we were before the pandemic. Importantly, the number of job openings is still higher than the number of unemployed workers in the U.S., so we still have a bit of slack in the labor market. One thing to remember, however, is that not all new jobs created are filled by someone with just one job. The number of multiple job holders was about 8.5 million in March, near the highest level since the Bureau of Labor Statistics began collecting data on it in 1994. What is perhaps more concerning is the number of people who have both a primary full-time job as well as a secondary part-time job. This number was 5 million in March, one of the highest levels recorded and well above pre-pandemic levels. This underscores the troubles that many households are facing right now. Most people don't work full-time at one job and also get a part-time job just for fun. Many people are struggling financially in the face of higher prices on pretty much everything because of the inflation we've gone through the last few years. This is important to keep an eye on because of how important consumer spending is for our economy. If more and more households are struggling to get by, they don't have much choice but to cut back on discretionary spending. If this happens on a large scale, it would tip the U.S. economy into recession on its own. That being said, let's look at how the overall spending levels are trending. Right now, we just have data for the first 2 months of the first quarter, but on an annualized basis, they are already up 2.7% over the first 2 months of the fourth quarter of 2023. This is down somewhat from the 3.3% annualized growth in the fourth quarter of 2023 and the 3.1% growth in the third quarter of 2023, but it is still a very healthy growth rate for an economy that is heavily reliant on consumer spending for growth. The overall consumer spending levels are suggesting a robust first quarter of 2024. Let's look at how some of the other sectors of the economy are faring. Total exports were at a record high level as of February, indicating strong demand for U.S. goods abroad. Imports were also up, however, which managed to drag down the balance of trade, which will make a negative contribution to first quarter GDP. Total private construction spending edged down in February from the prior month, but looking at both January and February together, they are up comfortably from the first 2 months of the fourth quarter, suggesting investment in private structures will be a positive contribution for the first quarter. Industrial production has been trending sideways over the last year and looks like we're seeing a bit of weakness in this area of business investment. Federal government outlays are up from where they were last year, but appear to be down from the previous quarter on a seasonally adjusted basis. However, Total employment for federal, state, and local government continues to head higher. Overall, we're on track to see another good growth number for the U.S. economy in the first quarter of 2024. There aren't a lot of cracks showing that would suggest a recession is on the way. Consumer spending is robust, and higher interest rates brought on by the Federal Reserve's fight against inflation have yet to show they are weighing heavily on the U.S. economy. While it's true that the Fed's tightening of monetary supply can have lagged effects on the economy, it's been more than a year and a half since they started raising their Fed funds rate and about 8 months since they stopped raising rates. We have yet to see the U.S. economy stumble, and any recession is still months away if it were to come. One of the biggest risks out there right now is the commercial real estate market. This year there's an estimated $1 trillion in commercial real estate loans coming due, and with higher interest rates, many commercial borrowers are at risk of defaulting. This can result in many banks that issued these loans to become insolvent and trigger a banking crisis. In my latest video on the commercial real estate market, I covered the most recent data for that sector, and market collapse is not imminent right now. I'll be releasing an update on that in the weeks to come, and I'll have another update on the U.S. economy overall next month. An economic recession would be a big blow to the housing market right now, as it would sap demand when demand is already weak due to high home prices and mortgage rates. For the time being, we don't have to worry about it, but it could become a problem in the second half of the year, depending on how developments in the commercial real estate market play out. If you want to stay up to date on the latest trends and what they suggest is coming in the months ahead, make sure you're subscribed to this channel and hit that notification bell down below so you know right away when my next video comes out. And if you found this video useful or at least mildly entertaining, go ahead and hit that like button down below to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.